The Fed leans into the economy or tries to help the economy, most fundamentally by changing the overnight cost of money from today to tomorrow. It's called the Fed funds rate for ancient etymology. And the Fed has been at zero now since 2008. It just seems longer. 2008, I mean, it's 7 years that we've been at zero. And the Fed, Janet Yellen, has done a wonderful job of beating the tom-tom drums, warning everyone that we're coming off zero. We have to come off zero. We have to come off zero because zero is unnatural. We have to begin some process of normalization. We have to come off zero because we have bubble risk in both stocks and bonds. We have to come off zero. We have to lift off. The economy is improving, the job market is coming, we have to lift off. And everybody in the markets, especially in the bond market and hence mortgage markets, we're not worn out by listening to the tom-toms, but we've been at zero for so long and the Fed has been warning about normalizing for so long that everybody's just sort of tuned it out. It's kind of like Greece and Europe. This week, Yellen gave her semi-annual Humphrey Hawkins testimony to Congress, and she did an inspired job. When the future is uncertain, it's the Fed chairman's job to appear in scholarly fashion, to appear with long dissertations on details of the economy and what the Fed is watching and thinking, but to fill the room with fog. And I mean fog so dense you can't see across the desk, and that's what she did. And she was completely misunderstood. The Wall Street Journal, New York Times, and Financial Times all ran separate and contradictory headlines after she appeared. The bond market improved thinking she was being dovish by not saying we're going to tighten tomorrow, or at some specific time, or in response to some specific stimuli. But she made it very clear that they're coming. And her colleagues, there's a tremendous amount of misinformation about the Fed in terms of which persons at the Fed to listen to. But the important ones, since Wednesday, two of them, the Vice Chairman Stanley Fischer and Bill Dudley, the New York Fed President, who are both terrific people, have made it very clear that they're coming. Fischer today said June, maybe September, but they're coming. The markets are beginning to internalize the idea that they're coming. You have to try to figure out what it means. If the Fed goes from 0 to 0.25%, the world doesn't end. We don't have Wall Street bankers selling apples on corners, but the Fed historically, every time it starts to tighten, keeps tightening, and gradually a year, 2, 3, 4 later, we have a recession. So one question is, once they begin to tighten, how much do they have to do? Another one has to do with normalization. Where might normal be in a global economy that is unrecognizable compared to all prior business cycles during the lifetime of the Fed, 100 years. This one doesn't look remotely like any of that. Where is normal? We used to think of normal as 4%. 4% was normal through the 90s and the O's. The Fed scattergram still suggests that something like that is appropriate. If the Fed went to 4%, the economy would come to a standstill. Maybe the economy changes. Nobody knows. Today, also, Bill Dudley said something unsettling to everybody, which the markets did not internalize, at least not yet, which was the Fed not only wants to raise the short-term cost of money, it wants to see long-term rates rise. In retrospect, one of Alan Greenspan's great errors in the credit bubble was to tighten the Fed funds rate, to bring it up from 1%, bring it all the way finally to 5 and beyond, and followed by the disaster of Lehman, but that wasn't the Fed's fault. The Fed's fault was being idle. But in that span, the long-term interest rates didn't rise. Fed kept chipping away 0.25% at a time at the overnight rate, but not long-term rates. Dudley today said that if increases in the short-term rate don't cause increases in the long-term rate, then they'll come harder. Now that hits us. And one of the limiting conditions on the Fed is what happens to housing. All of it is contingent on what continues to happen in the labor market and in the economy. There's doubt by a lot of people that traditional metrics like the unemployment rate really reflect what's happening in American households. And so, here we are, the last Friday in February means that the next Friday is the first Friday in March. Keep a firm grasp of the obvious. That means that we get jobs payroll data next Friday, and we get the twin ISM numbers this coming week ahead. And it's just a wild hunch, but I have a feeling the economy is not as hot as it's cracked up to be. And there are more headwinds than we like to think. And next week is going to be a reality. Next week, the Fed's longer term thinking will collide with what's actually happening right now. See you next Friday.